This is a conversation with a number of experts that we have on stage with us today to talk about deploying investments into the climate space, which is it's a broad mandate with a lot of different opportunity sets, and we're hoping to cover not just the opportunity set, but how people are approaching it today. What the balance between return expectations in the space should be relative to impact, which is always a hot topic among people deploying capital in the space. We'll also touch on a little bit of geopolitics because we've seen some volatility in that in the U.S. in particular, but that the U.S. is not the only place where we've seen material policy change. And then we'll look to the future and think about the energy transition in the climate space going forward with some of these groups and where the opportunity will be on a go-forward basis. So with that framing, I will do a brief intro myself and then turn it over to my panelists. My name is David Swift. I work at General Atlantic, specifically on the Beyond Net Zero strategy, which is a growth equity-focused investment strategy in the private space that deploys capital into opportunities both in the energy transition and climate arena. We launched the fund in 2021 and have made a number of investments that we hope will both generate returns for our investors, but also have material impact in the climate and energy transition space that we're focused on. So with that, I'll turn it over to you guys to do a quick intro.
Great. Thanks, David. Hi, everyone. It's great to be here. My name is Lee Chen Ma. I head up the Sustainable and Impact Investing Research team at Cambridge Associates. I'm based in Boston. Cambridge Associates is a global investment firm. We work with over 1,000 asset owners, so think foundations, endowments, families, pensions, advising them on portfolios, total portfolio across asset classes. And I'll be talking a little bit more about what we're doing with those clients around sustainability and climate.
Hi, everyone. I'm Noelle Lang. I'm the Chief Investment Officer of Builders Vision. Builders Vision is Lucas Walton's family office. Lucas is a third-generation member of the Walton family, so the Walmart money. We have three themes that we invest and grant to, which are food and ag, energy, and oceans. And there was a recent Financial Times article about Builders Vision, so I'll let you all look that up and see more details about our culture and whatnot. But I just think we have a really unique, it'll highlight, and I will highlight throughout this panel, that we have a really unique structure of thinking about the solutions we're trying to fund and what type of capital is most appropriate to get to those solutions.
So hi, my name is Albert Chung. I've been at Allstate for a number of years, done a number of different things. I was in the fixed income group, and then I led our ag and timber effort for a little over a decade. And most recently, I'm leading our climate effort. So Allstate, as most of you know, is a property and casualty insurance company. The reason why we started this effort around climate 3 years ago was because first, as we noted with respect to catastrophic weather, the increasing frequency as well as severity kind of led us to think about, what can we do for our customers as well as for our insurance company to kind of limit or to bend the curve. The other thing with respect to climate is around kind of the investment opportunity as we think about transitioning to a lower carbon economy. Bloomberg NEF a couple of years ago said that the opportunity is around $200 trillion over the course of the next 30 years. And so that's about $7 trillion a year. And just to frame that number, that's what the US government spends on an annual basis with respect to Social Security, Medicare, and our military. And so we view that as a significant opportunity. And so that's something that we think is long duration and something that we want to lean into. And so we want to start early, start developing our knowledge, as well as developing the relationships that we need in order to be able to generate some attractive returns in making investments.
So with that framing, let's start from the top down. How do each of you define the opportunity set in the climate and energy transition today? It's a broad opportunity set. You've got private market opportunities, infrastructure opportunities, and there are some cases public market opportunities. So will you walk us through how you guys think about it at Cambridge?
Yeah. So my answer is not going to be that helpful because basically it is all of the above. If you think about the scale of the problem, right, climate change is going to throw everything at us, right, in terms of wildfires, drought, heat, flooding, and all the natural, right, tools of the toolkit at us, humanity, and all their other natural species. So what do we have to do? We have to throw everything back at climate change, right, in terms of all the human-created tools around finance. So what I mean by that is you obviously have to work across public equities and private equity. You have to work across equity and credit, right? So all forms of capital along the stack. You have to work across kind of pure finance first, commercially oriented types of capital, and impact first catalytic capital, right? And everything that sits between. Anywhere from software to hardware and infrastructure, like all of those forms. And frankly, it's hard to put all of those things in very distinct buckets, and we can talk about that when we talk about portfolio construction, but a lot of these things that are going after climate solutions actually blend the lines or blur the lines among various asset classes. And that can be very tricky for asset allocators to navigate because we might be used to more very distinct asset class buckets or categories, but I think the sheer scale of the problem requires us not just to look at all the tools that we have, but also be creative and open-minded around how do you put those tools together that makes the most sense.
Yeah, I'll say ditto, and part of that is cheating because I came from Cambridge, so I like your approach a lot. But to then put it into the context of a family office, I actually started working with Lucas when I was at Cambridge. He was a client 12 years ago, so we have started to build. We have a 12-year track record in energy transition. Remember when it was called resource efficiency? And so we've really, but as I alluded to in kind of my quick opening comments, I think the Lucas Walton infusion over, what Li Chen described is that he believes strongly in breaking down the barriers between, even philanthropic capital, which is a benefit that we have, being in a family office. And so we actually have organized our thesis in food and agriculture, energy, and oceans around North Stars. And so we have these 2050 North Stars. And it's really, these are visions of where we would like the future to be in these three areas. And then we think about, okay, what are the frictions that are preventing us from getting to these North Stars? And how can we tackle that with the capital? So I think it's a really exciting kind of fresh viewpoint. And it really allows us to be very creative. Now, some people might hear that and say, oh, that sounds a little bit philanthropic, or maybe it's concessionary. We do have a really impressive philanthropic team who's dedicating grant capital to this. We do have a small catalytic portfolio where we are accepting concessionary returns, but it's really with an effort to prove that these markets are investable. So we go in where there is white space, where other investors aren't investing. And we know we'll be wrong a lot. So that's where the concessionary can come in. But we really, we know and we're starting to prove out that many of those areas, kind of subsectors of these themes, are market rate and we can have returns. And then we have the bulk of the assets and the bulk of the capital allocation is really in market rates of return across public and private markets. And that's where I started with Lucas 12 years ago. And so if you think about, we kind of take all of the above approach, so ESG factors in public markets to thematic strategies to really dedicated, private capital allocations across venture, private equity, real assets, et cetera.
Yeah, so I'm going to be a little bit more prescriptive in kind of the way we think about it. And so when we define climate, we define it around, carbon emissions mitigation, as well as adaptation and resilience. And then when we think about the segments that we want to invest in, we're looking at ag, tech, and food. We're talking about alternative fuels and energy, carbon markets, circular economy, sustainable materials, and sustainable transport. And if we think about kind of the investment types that we're targeting, and let me just preface that by, at Allstate, on the private side, our focus is primarily around private equity and real assets. And so as we think about, where we could lean in and have both an impact as well as generate non-concessionary returns, we kind of ended up with, you can invest in climate tech, which is venture capital, or you can invest in growth. And let me just say that 30 years ago, Allstate made a purposeful decision to get out of venture capital and lean into equity, which I think if you look at sort of the return series, that was the right decision. But given the fact that we have sort of this new mandate around generating non-concessionary returns as well as having an impact, we thought the easiest place for us to lean into initially was on the growth side, right? Because has similar characteristics to buyout. It's something that our investment committee could get their arms around. And so as we thought about kind of what is a prudent step for us to take to be able to be productive in terms of being able to make investments, we kind of leaned into growth.
So a follow-up question for you. You have a clearly defined investment landscape, but it's still a maturing investment landscape. A lot of the growth strategies, the venture strategies, the private equity strategies that you're looking at are on Fund 1. Right. So how are you evaluating those managers, and how are you thinking about defining success when it's still a maturing asset class?
Yeah, and I think this is a really difficult question kind of for this segment. And I think different people will have different approaches. So as I mentioned, I led and developed our ag and timber practice back in 2011, ran it for about 10 years until I was asked to step in on the climate side. And again, Allstate, I think, has an approach that's pretty consistent with other institutions in the sense that we're trying to find those managers that have a successful track record and make fund commitments and then make co-investments around that. And so, when I started the ag and timber, we did a similar thing. We went out and mapped sort of the timber managers as well as the ag managers. The timber managers had been investing for about 10 to 20 years, and so they had a legitimate track record. And so, unfortunately, that track record was bad, right? And so we kind of pushed that off to the side. And then with respect to the ag managers, right, they were just getting started around 2011. And so at best, the best ag managers had either raised capital and had deployed some capital, but not a lot of it. And so we had this choice to make. We can either invest with managers that we didn't have a lot of conviction around, or we can pursue a direct strategy. And what we decided to do was pursue the direct strategy and everything that's entailed in pursuing a direct strategy. And so we had to learn a lot about both ag and timber. And it was reasonably easy to do because although it's complicated, it's a relatively finite universe, right? Finite set of information. And then we had to figure out how to originate, underwrite, as well as manage. And so we had to establish relations. And so we had to learn a lot about kind of the segment and the people in it and make sure that we were in the right information flow. I share that because, when I was asked to lead timber, when I was asked to lead climate, the manager set looked very similar to the ag and timber manager set in the sense that a lot of managers were on their first or their second fund and were really difficult to underwrite, right, just based upon their track record. And so what we've kind of implemented is a hybrid model in the sense that we're looking at direct investment opportunities within certain segments, and the segments that we're leaning into is ag tech and food because of our legacy ag background, so we think we've got an edge there. We're looking at battery and energy storage because that's at the intersection of electrified transport and renewables, and so that would give us a better understanding of those segments. And the last is around grid and transmission, and the reason for that is because that's a hurdle to electrification. And so by investing kind of directly in those segments, we're developing a point of view, and then we're also getting to understand what the managers are doing kind of within those companies. Are they investing in it or are they not? And if they are investing in it, why? And what's been our point of view? And so we're taking kind of our direct investing kind of capabilities, and then we're also looking at co-investment opportunities with fund managers that we've made commitments to, as well as fund managers that we haven't made a commitment to. And again, the entire kind of intention there is to try to understand the fund managers and see if they're making assumptions that are consistent with the way we would underwrite that business. And so that's how we're going about and underwriting our managers. So again, I don't think this works for everybody. I think it works for us because I think we're one of the few groups that have leaned into and specialized around climate. And so we're able to do that. But if you're doing climate like 50% of the time or a quarter of the time, you're probably not able to do this. And so I think that's the advantage that we have as an organization because we said, hey, we want to do climate, and we're going to put a dedicated team. And so since we have a dedicated effort, we're able to do a little bit more.
So Cambridge has got a bit of a broader focus. You talked about this. You're throwing everything at the climate space. That's public markets, private markets, some things in debt. When you think about that in the investable landscape that you have in building those client portfolios, how are you balancing those different asset classes?
Yeah, I think you have to be really intentional around the role in portfolio, right, and how that intersects with the type of capital and the type of investment manager and its strategy. So think about any technology that goes through its full life cycle, right? Maybe it starts in the lab, and that's typically funded by early stage venture capital, right, to make sure that that lab gets from an idea to maybe early commercialization, right, or some type of early prototype. You want the right technical, commercial, venture capital partners to really focus on that part. And then as it scales up, you want growth equity, right, growth type of capital, to have a really commercial mindset, go to market, understanding the demand, right, and having all the networks there to then take it up to the next level. That could be growth or buyout. And then, of course, along the way, you want infrastructure, project equity, debt, and then, of course, going through public markets. And obviously, we're not necessarily tracking each technology from A to Z, from lab stage to IPO, but when you're building multi-asset class portfolios for these asset owners, right, we want to make sure that we are not just focused on the super early stage disruptive type of technologies. We also want to be backing the ready to deploy de-risk technologies that can scale today, right, because the problem is here today. And so when we're building diversified portfolios, obviously we are very attuned to the specific client's risk tolerance. Some of our clients can't do venture capital, right? They have to focus on later stage and buyout and infrastructure. And some people can't do debt, right, for various tax reasons or jurisdiction reasons. So we're really trying to combine the various tools, right, in a way that not just matches the client preferences and the mandates, but also makes a ton of sense from a climate perspective and making sure that you're again, dosing the solution in the right way for the moment.
Noel, you have a little bit of a different approach. You have a little bit more flexibility in the capital that you can deploy. You can think about returns and you can think about catalytic capital. Your duration might be a little bit longer than most allocators. So can you tell us about how you prioritize the opportunity set and what you guys are focused on?
Yeah, I think prioritization is something we talk about a lot at Builders Vision because there is a lot that we can do. So we're still honing that. But I think we have a pretty big team. My team is 27 people. We have a few open positions. So once we get all those filled, and so I think from from the bulk of the assets that are market rate and diversified and more of an endowment style type portfolio. We actually have a few of those portfolios, like most family offices. We have a number of portfolios we're investing, taxable, tax exempt, et cetera. So we're really, that screen is really on kind of, like you were saying, landscaping the opportunity set, no matter, depending on the sector, and then identifying kind of the managers and the trends, that we believe are the future, and just getting really those top tier, opportunities. And again, we have a 12-year track record in that. So a lot of times when I'm on these panels, we talk about performance. And so I'll just highlight, that with this 12-year track record, we have a couple of data points that I think are really interesting. One is that because we knew this type of investing would kind of be under scrutiny for a long time, we created a composite in our performance report that is just the public markets equity investments that are ESG and thematic. And over this 12-year period, they are the asset class or the sub-asset class that has created the most alpha over their benchmark over this period. Even in this, we've had kind of a difficult period, in the last couple of years for ESG and thematics, generally speaking. But the long-term returns are extremely strong. And then in the private markets, we're actually just reviewing some really great analysis the team did, again, on kind of alignment to our North Star themes and in our track record. And there's a really great page they created that, again, we kind of break out in the performance report our traditional VCPE, our impact VCPE, and the impact over this long-term period, the impact venture capital and private equity has done the best out of any of the private investment kind of sub-asset classes. So I think, there's this constant question of, do you have to give up return? These were largely emerging managers. If you count emerging managers as somewhere between funds 1 and 3 or 4, that is almost the entirety of what we've invested in. These emerging managers just take different flavors. Like these are the most institutional of them, and I can't say that we've gotten all of them right over the years. But anyway, that's a long way to say, for the bulk of the assets, we, prioritize these, top tier opportunities. And then for the catalytic portfolio, actually the team is split between the market rate team and the catalytic team, which is by design. I think you can be an investor that thinks across both, but I have found it's very difficult to do that. And so the catalytic team, as I mentioned, they're really looking at, where do we think the future is, where are investors not going yet, and where can we try to prove it out? And really every, kind of that's an evolution over time, but every couple of years we're re-examining, do we still think we're right there? Should we pivot? How should we be allocating that very precious capital? So the prioritization is definitely more art than science, but focused on the long-term goals that we have in mind.
You hit on this return versus impact struggle that I think a lot of people wrestle with. We get questions at GA pretty consistently. I think investors, for some odd reason, treat this as a zero-sum game.
Yeah.
Right? Like if you're making an allocation to something that is in the climate space, the energy transition space, it's having a positive impact on the world or towards decarbonization, I must be giving up a unit of return in exchange for that. We'll start with Albert. How do you think about that?
Yeah, you know what? I think generally speaking, that point of view would be right, except for the fact that this is such a large segment, right? And so again, like BNEF kind of indicated, 200 trillion over the next 30 years. And so that's a lot of dollars that's flowing in. And so I would say if it was somewhat like smaller, then you might be, but you're basically investing in a large pool. And there absolutely, I think, is an opportunity to both have impact as well as returns. And I think the way we think about it is, I think if you're returns driven, right, that the companies or the technologies that you're investing in are generating returns, then it will have an impact because you'll be able to scale it. If you're not generating returns, then the reverse is true, right? It's probably a one and done, right? And so that might be catalytic capital, but that's not something that we would be interested in. And so to the extent that you are able to find those companies that do a good job and are scaling, I think you can continue to invest more capital until it doesn't, right? And so that I think is the key, is to focus in on the return side. Yeah,
I agree that without the returns, it doesn't get to a self-sustaining level of scale that drives real impact, right? It's dependent on either government policy, which we're going to get to, or some catalytic capital to keep it moving. And you have to generate that flywheel of profitability, right, for the market to carry it forward to a scale that's going to really matter. How do you guys approach it at Cambridge? When you're talking to managers on the private side or the public side, how are you wrestling with the tension between returns and impact?
Yeah, so I'll share some data because we track actually deal level performance going back to the early 2000s in the sector. I think the sample size is now over 1,500 deals done by specialist climate VCs, PE, infra funds, generalists, right, that might invest 10% of their capital into the sector. So we've captured a lot. Of course, in the early days, in the clean tech 1.0 boom bust era, we'll just call that 2005 to 2012, when we looked at those deals, those returned kind of mid-single digits on a deal level IRR basis, on an average basis. 2013 to 2021, deals that were done in those years, we're looking at high teens, right? And that's across venture, growth, private equity, infrastructure, and because it does include some real assets, it tends to blend, right, down a little bit because infrastructure tends to be lower risk. So if you look at that, right, mid-single digits in that first era, high teens in that second era, right, that's a remarkable difference and speaks to the lessons learned, right, from that first period, how managers and operators and entrepreneurs have adapted their strategies to be much more commercially oriented. And I think hopefully the allocators have gotten smarter as well about where to deploy, right? What that tells me is, look, you can have periods of underperformance in any sector, right? We've all been through waves of overinvestment, right, underinvestment, boom, bust in not just climate, but in right? Biotech, in semiconductors, and many other sectors. So I would say it's not a necessity that, well, I think it is almost guaranteed that some investor will be underperforming at some time, right? But it is about how you maintain discipline and rigor in your underwriting, combining what you think of where the world is going on a macro basis, sector trends, and then down to the company level analysis, right? They all have to come together for us as investors to make it work. And so in that context, right, we do not expect to concede on returns in order to generate impact. It's a different story when your whole intention and thesis is around, right, kind of that catalytic, and you're, by design, taking a lower return. But if you're seeking market rate return, there is absolutely no reason why you should be underwriting to below market rate returns.
All right, I'm going to flip the question on its head a little bit. We're going to shift away from returns and into impact. And this is a jump ball question. As you think about impact and measuring the impact that your managers are having or that your direct investments are having, both on the returns-focused strategies or the catalytic capital, and I'll start with you, Noel, if you don't mind. How do you think about that measurement? What are the best practices that you've seen either you guys deploy or others?
This is such a great area of this field and really burgeoning. I mean, the impact measurement and management field has been around since impact investing started decades ago, but I think it's really maturing, and so it's very exciting. And we are lucky enough to have a 3 or 4 person impact measurement and management team that sits alongside the investment team and helps us, develop measurement best practices and whatnot. So, we are still, but I would say we're still on our journey. We did create a really nice 50-page report 2 years ago that you can all check out, our very first impact report. And so I'd say, we incorporate impact measurement and management in the sourcing phase, in diligence, while we're invested, and then at exit. So it's very sophisticated, but we are still kind of working our way through each of the portfolios we manage in each type of capital. So we started with the catalytic pool because their impact is of the utmost, and have now moved on to the private side of the market rate portfolios. We're kind of just getting into the public side. But I think for us, it's about measuring what is important to Builders Vision, again, those North Star goals that we have, but not overburdening the partners. And so trying to get that, kind of just right, and measuring long-term outcomes. So you'll see in our report, we're measuring things that are very specific to an investment, plus some overarching metrics such as greenhouse gas emissions, things that you would expect.
Albert, what do you expect from your managers from an impact measurement perspective?
So we have a corporate kind of measure that we're kind of working our way towards. But I would say we're relying more on our managers to be able to make that calculation for us. And so, I think what I'll refer to as the common sense approach to climate investing, it's kind of like the sniff test that, this kind of smells like this is a climate investment and this doesn't. So I'll give you an example. We were talking to a European manager, which I won't identify, but they were investing in recycled paper mills. Now, recycled paper mills have been around for a really long time, and I would not categorize that as a climate investment, right? So that didn't necessarily pass the sniff test. But I think, stuff around CEA, right? That is something that I think, while you may not necessarily have the carbon emissions reduction because you're using energy, and depending upon whether your energy source is a renewable source or not, right? But having local production, right, I think makes a lot of sense. And with respect to water, right, the water usage in a controlled environment or in a greenhouse is much more efficient than using something in field. So again, I take more of the common sense approach towards climate investing. And so if it makes sense, then we'll push it. And then we're asking our managers, right, to record that for us.
Makes sense. Do you want to comment on that, or do you want to go to geopolitics? Your call.
I'm happy to comment on impact measurement and reporting. So I think impact measurement reporting can really span a full spectrum of different scenarios. On the one hand, I think in its worst form, it is a mechanism for impact washing. Yep. It is a check-the-box exercise to report to various stakeholders, and it is, another form of marketing. In the best of times, when impact reporting and management actually works, it is an accountability mechanism for both the underlying company, for the manager or the GP, and the allocator to all ensure that we're all in lockstep, going for the outcomes that we all want. And it rarely happens, of course, getting to that best outcome. But I think that if we use that as kind of the bar, what it allows for is then some really candid conversations, right? So you can say, this is what we're trying to get to. What can you do to make sure we actually get there, right? What can you do to improve your measurement, making sure that it's decision useful, making sure that it's iterative, right? We don't want to kind of set it and then forget about it. We actually want to come back to it and always revisit. So I find that the impact measurement, because it's so fluid, there aren't common or kind of commonly accepted practices. It allows for really engaging conversations and behavioral change from the allocator's perspective when we're looking at fund managers.
Can I say one more thing on the topic?
Sure.
I'm really excited about that we were able to align our long-term incentives, so getting kind of to what sometimes holds people back from doing impact investing is that they are paid on performance, and they think, whoever they are, CIOs and others think they're going to take a performance hit. At BV, to put our money where our mouth is, we said we're paying people, and it's the entirety of the office on both the financial performance, so everyone is incentivized to make sure those market rates returns are there. And then we also have an impact multiple, so in our long-term incentive plan. So we're really, I'm sure it's going to be a little, we've just rolled it out this year, so it'll be evolve over time. But what I really like about this versus some managers that I've met who have an incentive piece in their carry and whatnot around impact is that we're making it more of a reward. If you generate impact, you'll get more money. Whereas a lot of times you'll see, at least I've seen with managers who have it, it's more of a stick. If you don't generate the impact, you're going to lose your carry, or lose part of your carry, So anyway, I just to kind of continue to push, I think, the field forward. We're trying to be innovative, across operations, incentive, and how we invest.
Yeah, I appreciate the carrot versus stick approach because it can create the wrong incentive in certain cases, especially as the data gets better, right? Because you have a set of assumptions going into, you make an investment on a certain set of assumptions, you get better data, and you realize that the carbon impact isn't what you thought it was going to be. It's still going to be great, but it isn't. Now we have on the ground data, and so. We've seen some of that with some of the investments that we've made at GA. We had assumptions, and now we get better data, and we have to continue to revise it every year.
Can I just add one more point? I'm not just trying to delay the geopolitics.
You might be. It seems like you are, but it's okay.
Let's go down from one to, So a lot of times when we talk to managers, especially when they're on Fund 1 or Fund 2, they'll say, yeah, I get you want to measure impact for your asset owners, but look, we are a $50 million fund. We're just trying to, get by, right? And we're building a team. We're trying to make some investments. There's just no way we can report on all these metrics at our scale. And I totally get that. We want to be very mindful where in the life cycle these fund managers or these companies are. We want to be thoughtful partners. Right? At the same time, imagine if a fund manager that invested and said, sorry, we're too small to provide you with any financial metrics or performance, right?
Yeah.
IRR, TVPI, multiple on invested capital, sorry, we don't have the resources to do that. Right? That would just be absolutely unacceptable. And I'm not saying that impact measurement is exactly the same thing, but you should also expect, right, some types of outcomes, conversation, reporting, even if it's like 1 or 2 KPI, right, per metric or per deal that highly aligns with that business's value proposition. It can start small, start easy, and then work your way up as you scale. So that's, I think, it's been a helpful conversation with certain GPs that are very, very small and emerging.
I like that. Now, can we shift to geopolitics? Okay.
Yes, I guess.
I won't start with you. How's that? We've seen a pretty dramatic shift in the geopolitical environment and in the policy in the U.S. over the last 12 months as it relates to climate. So I can't let my panelists off the hook without at least some comments and some reflection on what that means. From my perspective, there's a pretty large disconnect between rhetoric that we've seen in the press and then reality on the ground. A lot of the operating companies that we've invested in are experiencing better growth rates this year than they did last year, irrespective of the policy changes that are taking place. But I would like you guys to comment, and we'll start with you, Albert, if you don't mind, on what you're seeing as a result of these changes in the U.S. and comment on Europe as well, because the U.S. isn't the only place in the world that does climate investing.
Yeah, it's interesting because we've had conversations with a lot of our managers around the impact of both the tariffs as well as the One Big Beautiful Bill. And I would say for the most part, and I've been surprised by this, I'd say for the most part, our managers have indicated that, to your point, David, that their companies are performing better year over year for the most part. And so it's been surprising, but where I think it has provided pause is on new investments, right? So I think the uncertainty around the tariffs, the uncertainty around the One Big Beautiful Bill has created kind of a pause. And I think if you look at kind of the data around first half this year in terms of climate investments, it is down year over year. And so I don't think that's the only reason, but I think that could be a cause.
Well, follow up to that, if there is a pause in capital deployment, and I'd like my other panelists to comment on this as well, are valuations getting better? Are you seeing an opportunity for capital to step in this moment against the grain, against the headwind, and pick up some really unique investment opportunities?
It does seem as though, from kind of my seat, that in a lot of situations, the valuations are becoming more attractive. And so there is an opportunity. Now, whether valuations are attractive enough is, I think, the question that we're trying to answer.
Yeah, I think we certainly are adding additional rigor and consideration, on our diligence when we're looking at new opportunities. For example, we've been looking at something in the credit space that, is investing in residential solar. It's not that we're not going to do it, but we're just taking a pause, evaluating, seeing what we're, all of it will flesh out. But I think for me, I have been probably one of the more optimistic people in the office in this period, probably because it's my nature, but also, we have lived through a couple of these cycles, and it's not, it's disappointing and so it's challenging, but I do think that maybe, in the 2020 to 2022 era, maybe start back 2018 to 2022, we were a little willy-nilly with valuations and allocating capital and whatnot, and I think this is a really healthy reset, and we'll just, I do think there are really great opportunities. I think the really strong investors will shine, in this period, whether it be managers or allocators. So I'm very excited about the period. Again, not without kind of going in eyes wide open with the changes. And I think we have this in our track record. When Lee Chen and I first started working together, I remember sitting in your office and, Lucas wanted to invest in resource efficiency, and we had about 2 managers, I think we discussed in 2014 or 2013 when we were, we won't name them. One did really, really well. One is not so good. But again, I think we can just, I think this will just be a really good time to invest and to kind of rationalize the exuberance that maybe we had in the prior few years.
I would echo all of that, Noelle and Albert. I would just say, on the topic of geopolitics, right, you have to be able to hold both truths at the same time. Geopolitics matter, and geopolitics don't matter in climate, right? They matter, of course, when it comes to tax credits, right, the fiat issue, supply chains, manufacturing credits. Like, obviously, every sector is regulated and policy matters, but of course climate in certain areas are more sensitive to those specific provisions, and Noelle correctly points out we've been through this before, right? Those numbers that I cited earlier around the 2005 to 2012, a lot of that was also based on some hype, both technology hype and policy hype, and we've kind of been through that. I would say geopolitics don't matter in that, look, the climate problem is getting worse. It is financially material. It actually is valuable to do more with less these days. And when you think about energy security, reliability, affordability, those are all things that have value attached to those. And it's generally true from a bipartisan perspective. And when we're underwriting managers, right, we are still very much focused on the unit economics of the product without subsidies and how that matches up with the strategics or the incumbents' desire to transform their businesses to be resilient and future-proof.
I really like that, the holding both things that can be true at the same time, because it just depends on the duration as well of your investment and where you're deploying capital and the opportunity set. I have been told that at the 20-minute mark, we're 30 seconds behind, that we're going to open it up to questions from the audience. And we have one already, and we have two. And I don't know how this works. Somebody's going to come around and ask questions. There we go.
Hi, Jim Houston. I'm an early stage investor with E8 Angels, and I want to call out Noel for Builders Vision. They walk the talk. They invested in an early company, Photon Marine, that I invested in. So thank you. Question is for Albert. There's a phrase that insurance is the sharp tip of the climate spear for many people, especially if you're a homeowner in California, Florida, other places. Insurance companies sued PGE, including Allstate. Got a big recovery. 2 weeks ago, there was an editorial in the Mercury News, San Jose Mercury News, by the former California insurance commissioner saying, you guys are not suing fossil fuel companies because you hold them. They're big holdings for you guys. That seemed like a conflict of interest, and what you're doing could be just greenwashing. How do you rationalize that?
Nice, easy question.
I planted that one.
So I think what we do on the insurance company side, right, is I think we try to be responsible members of the community as well as responsible to our customers and responsible also to our stakeholders. I think, with respect to kind of where we are offering and not offering insurance, some of this is driven by regulation and the state regulators and our ability to pass through price increases on the insurance side, right, to match what's actually happening, right, on the ground with respect to climate change and things of that sort. And then what we're trying to do on the investment side is that, as some of you may know, for insurance companies, the returns on investment is very important to your profitability, right? And so we're trying to optimize our insurance, understanding that, if we start excluding certain segments, say energy, right, then we're going to be giving up returns, right? And so I think we're trying to manage a bunch of different, issues and trying to do it in as responsible a way as possible. And I get it that sometimes we do things and people say, like, why did they do this? But you kind of need to understand, like, the entire company is trying to navigate its way through a series of issues, which are complicated and it's challenging. So I know that answer doesn't necessarily satisfy you, but it is, I think, the reality of it, that we are trying to do the right thing in most situations, but sometimes you get backed into a corner.
Thank you guys very much for this panel. My name is Rebecca Michael. I'm actually a corporate finance attorney, and I am just here for my own edification. But I was really excited about this panel. So I was wondering, how are you evaluating and pricing physical climate risk like flooding, drought, or extreme heat into your investment decisions, especially in sectors or geographies that don't yet have clear market signals?
I can get started if you guys want a little reprieve. Okay. Evaluating it as a risk, I'm not going to answer that question because we're an investment firm looking for opportunity, and so they may comment on risk. But we just made an investment in a software platform called TechnoSilva, which the primary purpose of the software platform is wildfire mitigation. So they use geothermal imaging and satellite data to analyze wildfire risk, predominantly in California, for utilities. And they analyze that risk, and then they flag to a utility like a PG&E when there's elevated risk. We had a wind event. I'm a Northern California resident. We had a wind event in November of last year, and TechnoSilva flagged it to PG&E, and PG&E did some rolling blackouts. What's really cool about the software is that they can do the blackouts at the circuit level. And so I didn't personally have a blackout, but we had some neighborhoods in the Bay Area that did, and we didn't see a fire break out as a result of that. So one of the things that's really interesting about the utility space is that as we put more power through the lines get hotter and they sag more, and they're more likely to spark. And as the earth gets hotter, it gets also drier, and so the fire conditions are such that we're more likely to have wildfires caused by utilities. So this software is the leading software in the space, and we've seen an incredible amount of demand for it, both in California and now on the East Coast and other parts of Europe. And so it's one of the really cool, I think, opportunity sets for us as investors to lean into something that we can make an investment in, and then introduce that company to our contacts on the East Coast. We're actually working on Australia and Europe as well to get more resilience built into the system, and also benefit from that as investors. And so I think the resilience theme, which was my last question on this panel, is a key opportunity set for a lot of investors. But I'll let each of my panelists jump in if they'd like.
Yeah, I'll just say that we're also looking at opportunities. So we have a number. I didn't focus on it, but we do direct investing. Allocating and fund investing is the bulk of what we do by size and number of investments. But we have a very, very healthy direct portfolio as well. And that's both co-investments and just regular directs. But anyway, so we're looking at opportunities. So we have a number of kind of sensor companies that are measuring, flood risk and things like that. And so we believe that, what's measured is managed, and we need this data. So thinking of it like you more as an opportunity, And then I would say I don't get to do as many manager meetings anymore as I used to, which I always tell the team I get so excited when they invite me, but not my job anymore. But when I hear today, managers speaking, it's really, I think the most sophisticated analysis I hear is from the public markets managers. And it's not, and sometimes you hear it, and again, we're all in the space, so it's kind of a no-brainer. It's like, oh yes, if XYZ food and beverage company is opening up a plant, and there's water scarcity, that's just not going to work because they need water. But at the same time, I've seen over the years like real sophistication in that analysis and how they're incorporating it into their models and whatnot. So I think for me, I'm listening as mostly an allocator. I'm listening for how the managers are doing it, and it's getting more and more precise. And then we're trying to help contribute to the solutions on that precision too.
Those are all great examples on the opportunity side. I would just say from a allocator perspective, doing diligence on managers across different asset classes, right? If you're not asking that question, all of your real estate managers, infrastructure managers, right? It's not a complete diligence these days. And I would say it also comes up a lot on municipal bonds because, frankly, a lot of municipal bonds are at the front lines of climate change, at least in the context of the US. Of course, we can talk about emerging market as well. But those questions should be naturally included as part of every manager meeting, diligence meeting, and also really probing them, what are they doing to mitigate that risk?
Hi, I'm Michelle Carr from Evergreen Climate Innovations. And my question is for Lee Chin. I look at the sophisticated way Noel and the Builders team invest across capital markets as well, private equity, and then also philanthropic capital. And I think about the client base that Cambridge has, and of course, they're also given philanthropically. Earlier in my career, I heard someone say, philanthropic capital is needed where private capital won't go, or risk capital won't go. And I'm wondering if you're seeing any interesting requests or structures from your client base to use their philanthropic giving to have an impact on the capital markets in a space that capital is not going.
We have not spoken before this panel, or before this, because it's such a timely question. We are absolutely hearing that from foundation clients that want to leverage their philanthropic capital, right? Grants, PRI, to ensure that all of their forms of capital can be leveraged in a way that fulfills the mission or fulfills the mandate. So we are absolutely seeing that on the foundation side. With families, we have already been working with families leveraging catalytic capital, right, that complements the market rate impact portfolio, such that you're really getting, again, back to all the tools in the toolkit, right? You're not just using part of the toolkit, but actually the whole thing. And we're starting to see even some interest coming from outside the US, in the UK, in Asia, where historically they have not leveraged any of that philanthropic capital towards doing investments, right, or any type of below market rate concessionary investments, and now they're more open to it. So we're engaging in those conversations, and it is still early, but absolutely excited about opening up that entire segment of new forms of capital, because just market rate is not enough.
Thank you. Hi, everybody. My name is Kevin Smith. I'm an assistant professor of economics and finance at Beloit College. And so my question has to do about investing and knowing if there's a there, right? So we've heard a lot of conversation about different firms in the climate space, but how do you know, like, okay, this firm is something that we can invest in? Are you just looking at financials? Are you just looking at the potential growth of the market that they're in? What are you using to kind of determine if there's a there?
Yeah, so I can start. What is the there? I think the thing that we're focused on is unit cost economics, right? And then, the path to cash flow or path to EBITDA positive. And I'm going to say for a lot of growth companies, that's really challenging, because a lot of things have to go right in order for that to happen. And so as a result, many of those situations we pass on, because if we can't get to a reasonable degree of confidence, because you are starting on the growth side for the most part, right, with zero, especially within climate. And so I think that's basically what's transpired over the course of the last several years, is that the exuberance in 2021, 2022, and even to a part 23, right, that a lot of people got behind ideas without actually confirming that there is a path to profitability. Because as I indicated before, if you can't get the profitability, you can't generate the returns, then you're not going to be able to scale. And this is kind of like a one and done. And so there are numerous situations right now that are one and done. But the great thing about this marketplace is that those things get swept aside, and those companies that can generate the profitability are able to attract the capital, and are able to grow. And so it is that is what we struggle with on a daily basis.
I think just to tack on less about kind of the underwriting side of it, more on the capital supply today and fundraising. One of my peers has said, the syndicates are tired. There's some of us who have, and it's managers, it's family offices, it's, all of the above, have invested in this space, and maybe they've, supported a company or a manager, over a number of cycles, and then, in this period where there's a bit of a lull, a little bit of a downturn, it's very hard to fundraise again on many sides of the investing coin here. So what we're really looking at, I think, is the syndicate that is there, and what position, do we have to change kind of how we're investing? So for example, we used to, on the catalytic side where we have most of our direct investments, we used to say, we're never going to lead. Well, lo and behold, now we're leading rounds, but again, trying to be there when others aren't, and trying to flex. And so I think there's just so much there's so much that it takes to get those companies to that EBITDA positive, position, and trying to be, again, that catalytic force to, we're being very ruthless about it, but, trying to help these companies when there is kind of this lull.
Yep. Yeah, the one thing I'll add is that it's hard to generalize around industries or segments and say, hey, this segment I'm not going to invest in because of X, Y, and Z. Because what you need to do is you need to focus on the individual company, right? And as the company, so everybody else may not be, but you can find a company that is doing the right things, and those are the types of companies that we want to invest in. And so, there was a question around like which industries are we most enthusiastic about. I would say the industries that most people are enthusiastic about, we're probably less enthusiastic about those industries, right? And we're looking at the individual companies and saying, what is this company doing to make sure that their product is getting on the shelves and consumers want it?
So, sorry.
No, go ahead.
So many years ago, I had the privilege of having the late David Swenson speak in a business school class that I attended. And David Swenson, if you don't know, was the Yale chief investment officer for many years, basically pioneered the endowment model investing. And another classmate of mine asked him, so what's the number one rule or principle that you use when you're evaluating fund managers, right? And obviously Yale has done very well over the years. And he said it's the people, and the people, right? And I work in an investment firm. I love analytics. I love data. But at the end of the day, right, we are backing people. When we invest in a fund, right, we are signing literally a partnership agreement, right? It's not a transaction. It is a transaction, but it's a partnership agreement that will last for anywhere from 10 to 20 years with extensions. That is a long time. I've been married for 14 years, not even the end of a fund life, right? And hopefully many more decades to go. But that is a long time. And you have to make sure that the person who is going to be stewarding your or your client's capital is there during good times, during bad times, right? Will tell you the truth and can take your feedback. And I guess in my experience, we've obviously had our wins and losses with fund managers. The ones that are, in hindsight, the misses, right, are the ones that just the people are not the ones we thought we were backing. And I think if you're backing the right people, for the most part, you're going to be able to succeed.
Okay, we have another question.
I guess this is just in maybe a continuation of this diligence on the more qualitative side of people, and just trying to see, especially in a space where impact is so important and intentionality is so important, how do you get that more longitudinal view on managers? What are the types of questions you like to ask? And this is maybe for all three of you when you're looking at managers for different reasons. Because this is something I'm really interested in as an emerging manager investor. And because there isn't a track record, that's an area I have to spend more and more time looking at. So would just love to know how you kind of get into the grit and backgrounds of some of these managers.
I mean, I'm happy to jump in, but. So a lot of it comes up in referencing, right? So how founders, how co-investors see you as a partner, whether it's in the past or in current, looking at deals together, that is a big part of our diligence process. And because, right, it's not in your data room, we actually get to validate it through other sources. So that's like a big part of it. We obviously do a lot of like background checks on people we're doing diligence on, and it's over drinks. At some point, I'll tell you all the things that we found out about GPs that even their founding partners didn't know about them. So that leads to some interesting, awkward conversations. But yeah, basically, we try to learn about you as people and how you show up, both with your LPs, but also with your other key stakeholders.
And I think just to tack on a little bit to that too, thinking about it being an emerging manager and getting to this kind of what you were talking about, just what I always call impact sincerity, like who's the real deal and why. I always just think about like asking another layer of questions. It can be as simple as like, oh, why'd you make that decision? Well, how did you get to that decision? Well, how did you do that? And just really trying to uncover, each, like how they think, how they make decisions, and all that. And I think that, to your point about the people, certainly track record data helps a lot, but at the end of the day, it's the people. So just trying to really get at that. And I spent, again, back when this was my job, it's not my job as CIO anymore, but when, I used to do more manager diligence, I mean, probably annoyed a lot of you in the room who are managers, but I just don't rush it. Like there's no point in rushing. From our perspective, and so don't want to be disrespectful to people's time, but just kind of, spending quite a bit of time in different settings, with managers.
Yeah, I'd say, and I talked about this kind of previously, so we focus in on knowledge, and we think knowledge helps us develop relationships, and so going back to the people. And so the fact that, you know, we're looking at direct investing opportunities, I think provides us with a lens on some of the managers in a way that they're probably not used to us finding out about certain things, right? And so I think the more those different channels that you have, right, the better, because I think, you know, diligence I think is important, asking the questions, but then having your own sources and your own channels and your own perspectives that you've kind of found out about this deal or that deal, whatever, and then which management teams have they backed, how have they supported them, right? And so all those things I think are really, really important, but I do think it goes down to the people, right? When you find that right founder or find that right manager, right, they are going to generate returns for you. And so that's one of the reasons why we're trying to lean into this climate space early, right? So we become more knowledgeable, we establish the partnerships, and hopefully if we've done those things right, then the returns should be generated kind of naturally.
I think it's a great way to end our discussion because we're out of time. Join me in thanking our panelists.